Good afternoon, and thank you for joining us today. I am MAPER's board member, Eric Gould. A copy of today's presentation can be found on the events page of the MAPER's website, and a link to the handouts was included in the reminder email that was sent this morning. Please submit any questions you have for our speakers using the Q&A button located in the Zoom app. Questions will be answered at the end of the presentation. I will now turn you over to Sean Delaney, Senior Vice President, Institutional Client Group for Lazard Asset Management.
All right, thank you for the introduction, Eric, and good afternoon, everyone. We really appreciate you taking time over your lunch hour to join us today, and would also like to thank MAPERS for allowing us the opportunity to be a part of this webinar. As Eric mentioned, my name is Sean Delaney. I'm a member of the Institutional Client Group at Lazard, and I lead our membership with MAPERS. We're proud to have been a part of the MAPERS community for many years and are excited to have the chance to speak with you today. For those of you who may not be familiar with Lazard, we're a global investment firm headquartered in New York. We oversee $225 billion primarily for institutional investors across a wide range of global, regional, and country-specific strategies in listed equities and fixed income. On the ground, global fundamental research is at the heart of our investment approach, and managing assets on behalf of public retirement systems is a core focus of our business. We work with a wide range of public pension systems nationally, including many in the state of Michigan, and some of you may be familiar with us for specializing in non-US and emerging markets investing. Today, we're excited to speak with you about the opportunity set we're seeing specifically in emerging markets fixed income. And to that end, I'm pleased to be joined by my colleagues, Arif Joshi, who's the Managing Director at Lazard, as well as one of the lead portfolio managers and analysts on our emerging markets debt platform. Arif has over 20 years experience in emerging markets fixed income and has invested in the asset class through various economic cycles. We're also joined by Darren Madden, who's a client portfolio manager on the team. In terms of our focus for today, we know that low levels of interest rates combined with bouts of higher volatility has made investing in many parts of traditional fixed income less effective in managing public pension investment risks and objectives. However, we believe emerging markets debt can offer a potential solution. Over the next 50 minutes or so, we'll provide an introduction to emerging markets debt, including historical returns and characteristics of the asset class, risk factors, reasons to consider a dedicated allocation, as well as the outlook for emerging markets debt broadly. We hope you'll find our presentation to be interesting and informative. As Eric mentioned, we'd encourage everyone to ask and submit questions in the comments section, and we'll make sure to answer them during the Q&A period at the end. With that, I'll hand things over to Arif.
Great, thank you very much. And thank you to everyone for taking the time to dial in to this presentation. I know in this, for the last year, everyone's been overwhelmed with Zoom invites. And so getting an hour of your time is certainly a big commitment, and we appreciate that. So as Sean mentioned earlier, we're going to spend the next 45 minutes or so going through the opportunity set in emerging market debt, talking about both where there are opportunities and also where there are dangers, how it fits in to a fixed income portfolio, what to look for going forward in terms of trying to predict outsized returns, and the characteristics of the asset class from both a return perspective and a risk perspective. So we'll go along sequentially in the slide deck. We'll touch upon about 10 to 12 slides in here, and we'll make sure that we open it up for questions at the end. So just by way of background, my name is Arif Joshi. I co-lead the emerging market debt platform here at Lazard. We manage about $14 billion dedicated to emerging market debt. We're based in New York, and we've been investing in the asset class now for about 20 years. So let me start off here on slide one. I thought I'd start off with the biggest risk, and this is for everyone who has fixed income within their portfolios. By far, the biggest risk that we all face right now is duration. So what has been a significant positive tailwind for the better part of the last 30 years, basically since 1981, when Volcker conquered inflation and has driven very, very high returns in fixed income asset classes globally, that tailwind has now turned into a significant headwind. And the problem is really twofold here. Number one, bond math is such that when coupons and yields go lower, the duration of a bond increases. So the riskiness or the correlation to underlying treasury yields goes up significantly. So what we've shown here is the duration of a 10-year US Treasury bond is currently about 9.3 years. And so what this simply means is that if US Treasury yields go up by 100 basis points or 1%, from 1.74 to 2.74, you would lose 9.3% in capital return. And that would significantly overwhelm any coupons that you are receiving on those US Treasury bonds. And this is not a hypothetical example. We have, in fact, moved up about 80 basis points just in the last 3 months in US Treasuries. And so the first quarter of 2021 was the second worst quarter for US Treasuries since 1981. And so not only have durations or sensitivities to Treasuries gone higher, but you're also at a starting point where yields are at extremely low levels, especially as we are entering a phase of reopening, fiscal stimulus, monetary stimulus, and some of the highest growth patterns that we're likely to see in our lifetimes, both in the United States and outside the United States. And so what we've shown here on slide 1 in the yellow box is the amount of yields that can go higher before you lose that coupon. And so for US Treasuries, if yields go higher by 0.2%, that wipes away your annual coupon. As you get into US corporates, as you get into global corporates, that number goes up slightly. You have a little bit more cushion. But when you look at emerging market debt, in fact, the cushion is quite substantial, meaning that US Treasury yields can go up as much as they did in the first quarter, 0.8%, and it's still enough cushion to be offset by that running yield that you get by investing in the asset class. And so this is going to become critical to the analysis of where you want to be in fixed income going forward. Given that starting point, given that high sensitivity, you need to look for asset classes which are providing you with a substantial area of coupon and of yield. And then you have to ask yourself, well, what risks am I taking to generate that additional yield? And are those risks justifiable given what we know about these different parts of the world? So let me move on to slide 2, just to give you visually a sense of where we are. And so we've taken this back 20 years in the modern history of fixed income. And I mentioned earlier that the starting point matters significantly. Remember that in August of last year, just after COVID, 10-year US Treasury yields were at about 0.8%. Today, they're at about 1.65%. What we tend to look at more in fixed income are real yields. So essentially taking into account inflation expectations around the world. And what you can see here is that even with the recent move higher in Treasury yields, when you adjust those for inflation, real yields at the 5-year level are in fact at all-time lows. Real yields at the 10-year level have just barely inched above the all-time lows that they hit back in 2012. So again, a particularly dangerous starting point if you're in a fixed income asset class without a great deal of coupon to offset that. Second, when you look at the right-hand side of page 2, what we've shown here are volatilities. And so one of the best leading indicators for risk in any market, whether it's equity markets or fixed income markets, are where volatilities are in that market. And to put that in plain English, what it's basically saying is when volatility is low, the market is typically getting complacent. It's not compensating you for the risk that is likely in that asset class. And what you can see from this slide is that volatilities hit record lows in 2019, and it actually set the market up for some of the sell-off that we're seeing now in the early part of 2021. Volatilities are still very low on the US Treasury side. And so our base case, in addition to what I think the consensus base case for the market is that we will get further U.S. Treasury yields to increase going forward, and that will continue to be a headwind for most fixed income asset classes, not only for the next month or the next quarter, but likely for the next couple years before we normalize at a higher clearing rate. So let me now shift gears to emerging markets. Slide 3 is where EM is in comparison to the rest of the world. Now, anytime you invest in emerging markets, everyone knows that emerging market countries are now larger as a part of global GDP than the developed world. Now, that is absolutely not a reason why you should be investing in an asset class. Just because it is large or just because it has growth does not mean that you're going to get returns. But what it does tell you is that emerging market countries have become a much more meaningful part of the global growth cycle, of the global fixed income asset class over time. And on the right-hand side of page 3, what you can see here is that emerging market debt is about a fifth or so of the market capitalization of fixed income globally. So it is a meaningful part of the overall market. It's become liquid, it's become tradable, it's become effectively a real asset class over the last 10 years where you can get diversified exposure to a number of different countries. So at Lazard in the emerging market debt team, we invest in about 76 different countries. That is spread throughout Asia, Eastern Europe, Latin America, Africa. And so there are a number of opportunities, both of countries that are positively re-rating over time and countries that are deteriorating. And so really the secret sauce there is to do the bottom-up credit work to understand the drivers of each one of these economies in order to allocate capital to those countries that we think are on a positive structural path. Let me move on to page 4. So I hinted to this earlier, that emerging market countries offer you more yield. You can see this on the right-hand side of page 4. Essentially, yields today are at about 5.25%. Whether you invest in US dollar denominated emerging market debt or you invest in local currency emerging market debt. And that is contrasted against US Treasury yields, which I mentioned earlier, are at about 1.65%. So that is the yield pickup. Now, the real question is, okay, what is the real risk that you're taking in order to get those additional yields? And here is where it gets interesting. You're not actually taking additional balance sheet risk. And this is a strange statement when you're talking about a fixed income market. Because at the end of the day, when you invest in fixed income, the only two things you care about, if you're not taking currency exposure, if you're only taking dollar denominated exposure, you only care about that credit's ability to pay you back, which is a balance sheet exercise, or their willingness to pay you back, which is a qualitative statement. So the first thing we wanted to show here was the balance sheet. The single best metric to understand leverage within a country is called the debt to GDP ratio. So essentially the total amount, both external debt and local debt that that country owes divided by the total size of that economy. To start with the developed world, the United States right now is at about 115% debt to GDP. Before QE, before all of these different things that we added in the US over the last 15 years, this country used to be at 60%. Europe is also at about 120%. Japan is at 230%. So around the developed world, we have levered up considerably over the last 10 years since the global financial crisis. Contrast that with emerging market countries. That's what we've shown in blue here on the left-hand side of page 4. You'll notice debt to GDP ratios are much lower. And in fact, the average debt to GDP ratio in emerging market countries is right about 48 to 50%. So that's about half the level versus the average developed market country. So you should stop there and say, well, why in the world are these yields so high? Well, the real answer is because in an emerging market country, the modern history of these countries, meaning the institutional quality and credibility of these countries is only about 20 years. So it's only been since around 2000 that these countries have fully developed yield curves, that they have peaceful transference of power when you have elections, that they have inflation targeting regimes, floating exchange rates. So because you have less history, you are taking a risk that these countries may start deteriorating quickly. And the best way to see that is over the last 10 years in the developed world, we have been printing money and our currencies have been appreciating. In emerging world, if you print money, your currency depreciates. And that is completely due to credibility of institutions in the developed world versus lack of credibility of institutions in the emerging world. So it gets back to what I mentioned earlier, to the extent that you can separate out the strong governance countries in the emerging world. Chile is a great example of that. Mexico is a decent example of that. Indonesia is a good example of that. These are countries which over the last 20 years have put in constitutional amendments to limit the fiscal deficit. Indonesia has a limit of 3%. They've put in rainy day funds, again, in their constitutions. In the example of Chile, when copper prices go up above a certain threshold, it gets parked in a separate account that the government cannot touch. These are all examples of institutional credibility that certain countries have put into place over the last 20 years. And as a result of that, many of those countries have seen a positive re-rating over time. And so there is a significant opportunity set if you can zero in on those countries. To be fair, there are countries that are going the wrong way. Turkey is a great example of that, where 3 weeks ago, the president decided to fire the central bank head. Now, again, emerging market countries do not play by the same rules as the developed world. In the US, although we're not supposed to, we can pressure the central bank. The president can pressure the central bank. But there's been 200 years of history here where that tends not to result in completely different monetary policy. Again, not the case in the emerging world. And so as a result of that, Turkey does have to pay much higher yields or a higher cost of borrowing as a result of some of the policies that they've instituted domestically. Okay, let me move on to page 5. So the opportunity set in emerging market debt is split amongst 3 different parts. And so we call this the 3 different parts of the capital structure of emerging market countries. By far, the safest and oldest part of emerging market debt is dollar-denominated country debt. And that's this first column. It's about a $1.3 trillion asset class. And to be clear, these are emerging market countries issuing bonds in US dollars. So when you buy these bonds, you are not taking currency risk. This is dollar-denominated debt. And you might ask yourself, well, why would an emerging market country issue in a foreign currency? Well, it happens to be that when emerging market countries first started issuing debt 20 years ago, they did not have yield curves domestically that went out 5 years, 10 years, 30 years. So if you were an emerging market country and you wanted to issue a bond to finance a highway project, education, infrastructure, industrial plants, and so you had to issue a 10, 15, 20-year bond to match the cash flows, the only way to do it was to issue in US dollars. And so that's how this asset class began. And as these countries have gotten better and positively re-rated, they're now able to issue in their own local currency, but you do take currency risk there. So to wrap up in this first column, hard currency sovereign, that only means dollar-denominated emerging market countries. This is an asset class which is borderline investment grade. It's BB+ / BBB-. I mentioned earlier it has a yield of about 5.25%. When you take a look at the historic returns of this asset class, over the last 20 years, it's returned about 7.8% per year versus a volatility of 8.6%. So as you guys know, in investing in both equities and debt, anytime you can get a 10 or 20-year period where you can get Sharpe ratios that get anywhere close to 1. That is the definition of a bull market. So if your return gets anywhere close to the volatility, then that asset class is typically doing quite well. And here, the annualized return is just a smidge underneath the annualized volatility. So this has been a very attractive asset class to be in over the last 20 years. And a large reason for that is because we've had very few defaults in emerging markets. So when our countries default, it gets a lot of attention in the financial press, but there have in fact only been 24 defaults in the last 21 years. Again, the modern history of emerging market debt. So it's about 1 a year. And we remember the Argentinas of the world, who in fact defaulted 3 times over that period. And then we remember the Asian crisis in 97, 98, Brazil almost defaulting back in 2002. There are a couple of things to note here. One, default rates in emerging markets, either at the country level or the corporate level, are in fact lower than the same quality entities in the United States and Europe. So emerging market entities tend to default at a lower rate than the rest of the world. Second, when an emerging market country defaults, there is no Chapter 11 or Chapter 7 type bankruptcy procedure. It is a negotiated settlement between bondholders like ourselves and the country. And it tends to be that the country, there is a new government that comes into power, and they are highly incentivized to cure their historic debt in order to get capital investment back into that country. And so the result is that the average recovery ratio when an emerging market country defaults is around 50 cents on the dollar, whereas in the developed world, when a company defaults, average recoveries tend to be somewhere between 25 and 30 cents on the dollar. So number one, historically, you've had very attractive returns. Number two, historical default rates have been below that of global peers. Number three, even when you get those worst case scenarios of these countries and these companies defaulting, recovery values tend to be much higher. So looking forward, in an asset class that has particularly low debt at an absolute level, extremely low debt relative to the other countries in the world, in our view, there are a lot of opportunities here for outperformance when you're talking about fixed income allocations to dollar-denominated debt. The second column here is emerging market companies, and they are almost all denominated in US dollars. So again, this is companies like a Cemex, the largest cement producer in Mexico. In the case of Cemex, they have a significant amount of their revenue, in fact, coming out of the United States and Spain. Then you can go to Asia, you can go to Africa, Eastern Europe, where most of the revenues are denominated locally. What's interesting about emerging market corporates is that they are also largely investment grade. They're about 57% investment grade. So when you're getting into emerging market credit, in fact, most of it is investment grade, not high yield. They tend to be shorter duration than what you can get in the rest of the world. So some of the worries that we currently have in fixed income, which again is duration risk, leverage risk, it happens to be that emerging markets are particularly insulated from those two major risks going forward. Finally, I'll get to the third column, which is local currency debt. And so this is emerging market countries which are issuing debt in their own local currency. So not only are you taking the risk of that country paying you back, you're also taking the risk of that country's currency depreciating against the US dollar. And so this is a much more volatile asset class. You'll see on this slide, volatility is around 12% versus dollar-denominated debt, where volatility is around 8%. You'll also notice that over the last 20 years, the return versus volatility is much less attractive. And if any of you have traveled abroad, I guess not in the last year, but maybe before that, you would have realized that the dollar has been very strong over the last 10 years. In fact, the dollar has been on a bull market run for a decade. And so as a result of that, the emerging market currencies have been in a bear market for a decade. So every time you talk to an emerging market equity manager an emerging market bond manager, we will all tell you that all of our models show that emerging market currencies are in deep value. But to be fair, they were in deep value in 2018, they were in deep value in 2016, they were in deep value in 2014, and they kept depreciating. So the key when you invest in emerging market currencies or local bonds, which are denominated in those currencies, is not only do you need to have that value, but you've got to have the trigger. And the most important trigger when looking at a local currency investment, either equities or debt, is growth. And it's not absolute growth, it's relative growth. So as a general statement, when emerging market countries grow faster than the United States, then emerging market currencies appreciate. When emerging market countries grow slower than the United States, those currencies tend to depreciate. When you look over the last 10 years, I mentioned earlier, we invest in about 76 countries in the emerging world. Back in 2010, the average growth rate of these 76 countries was 6.2%. Before COVID, the average growth rate was 2%. So growth has gone straight line downwards from 2010 to 2019 in emerging markets. And if you take the last 6 years under Obama, the first 3 years under Trump, so you take out the global financial crisis, you take out COVID, the United States grew at 2.4% consistently under two completely different presidencies. And so when you put that all together, back in 2010, emerging markets was growing at 2.5 times the rate of the United States. And by 2019, the United States was growing at a faster rate than emerging markets. In a nutshell, that is why the dollar has been so strong over the last 10 years, while emerging market currencies have been weak. Now, looking forward, what you care about is where do you think the growth pattern is going to go over the next 1, 3, 5, and 10 years? If you believe that emerging market growth will go back up to its potential, and the US will stay around its potential, well, then you should start allocating out of the US dollar into emerging market currencies. But the key question is, when will we see that, and what are the triggers that we need to see to make that call? And I'll talk a little bit about that in the next couple of slides. Let me move on to page 6. We've talked about most of these risks. Interest rate risk being the lowest in emerging market corporates, the highest in dollar-denominated sovereigns, but relative to what you're seeing in US credit markets, it's lower across the emerging market spectrum. Credit risk is relatively low because most of our countries are investment grade. Most of the balance sheets are under-levered. Liquidity risk is on average medium. Remember, this is an over-the-counter traded market in dollar-denominated debt. So by definition, there's going to be less liquidity in debt, these types of debt markets, than, for example, in equity markets. And then finally, currency risk, which is only really existent over on the local currency side, as both countries and corporates that issue in dollars, you're not taking currency risk on that side. Okay, I promised that I would talk about return patterns, and we have return patterns going backwards, but I know what everyone cares about much more is what things are going to look like going forward. So let me start with page 7 here. So this is the definition of a bull market. When you see on the left-hand side of page 7, rolling 1-year returns and rolling 5-year returns for dollar-denominated emerging market country debt, the 5-year return has never dipped negative over this period. So yes, you may have had a single year drawdown of 3%, 4%, but as a general statement, you have been able to generate your yield plus a little bit from capital appreciation over the last 20 years. And again, this gets back to the grand majority of emerging market countries have stayed current on their debt. Default instances are quite low. If you can have a manager that can avoid those defaults, even more of the case why you should be able to realize your coupon and your yield, which again is about 5.25% for the dollar denominated side of emerging market debt. When you move to the local side, and this is on page 8, unfortunately, page 8 is the picture of a market that has had some trouble over the last 6 or 7 years. So it began in a bull market from 2003 until about 2010. And you'll notice the 5-year rolling numbers, the 1-year rolling numbers, they all started to dip in about 2010, 2011. And we stayed at 0 to negative returns all the way through till about 2019. And again, this is highly correlated with growth patterns in emerging markets. And you'll see what's really been dragging down local market returns is not the yield side. You're still getting paid the yield from these countries. They're not defaulting on you on their local debt. What's been dragging down returns is on the right-hand side, which is the currency performance. And so again, the value is certainly there, but what you need to pay the most attention to going forward is the relative growth of emerging market countries versus dollar-denominated debt. Okay, the final 2 comments regarding returns, volatility, and yield, and this is on slide 9. Usually we focus in the market on absolute returns. All of us have risk bogeys, funding levels that we need to be concerned about. But I think when you're allocating across different portfolios, what you really need to be focused on is optimizing every unit of risk to generate the most amount of return. And so you ought to be able to draw a line, a 45-degree angle from 0% return and 0% volatility up to 12% return and 12% volatility. And what you will find is that there is almost no market in the world, with the one example of US fixed income over the last 20 years, which is above the 1-to-1 trade-off of return versus vol. But when you look at almost every component of emerging market debt, and we've highlighted this in bold, we're sitting at about 0.7, 0.8 return versus vol. All of us who've been in the market and have been invested in US equities, it's been a great place to be over the last 20 years. But notice here that the return of US equities is about 11% versus a vol of around 14%. So in fact, US equities are right on that general line of where emerging market debt has been over the last 20 years. And then when you get out to international equities, EM equities, and global equities, it tends to be that there's a significant amount of volatility / risk, and you have not been compensated for that on the return side. And so it's even with all the crises that we've had over the last 20 years, COVID, taper tantrum, oil prices collapsing in 2014, global financial crisis, emerging market debt has been able to hit well above its weight level in being able to generate attractive returns for the given unit of volatility. Slide 10, which is a ratings comparison, so a quality comparison. So I think this tends to get somewhat overlooked when people look at emerging market debt, which is people tend to be surprised by the ratings. I mentioned earlier, we are in fact an investment grade asset class. Granted, we're borderline investment grade, but for most of our clients, they're either bucketing us in fixed income groupings, IG versus high yield, or if they're in our total return strategy, then they bucket us in a hedge fund bucket. But the general statement here is no matter what bucket you put yourself in, it tends to be that you're able to generate much higher yield for less duration for the given unit, for the given credit rating. And so again, to be able to realize that yield, meaning minimizing the number of credit events, is a critical part of harvesting these returns over time. Okay, the last 2 slides before we turn it over to questions. So I'm going to spend a little bit of time on page 11 here. And this is, I've hinted towards this throughout the presentation. it is a pretty clear picture when you're talking about dollar denominated debt. Great 20-year returns, great 10-year returns, no currency risk in that side of the asset class, very low default rates. When you default, recoveries are pretty high, and some of the best balance sheets around the world. Even a country like Russia, they run debt to GDP of 12%. They, in fact, have more foreign exchange reserves than they have the entire debt of the country. So some of these countries in emerging markets, from a debt perspective, on their ability to pay us back, are really, they should be rated A+, AA. But for the institutional reasons I talked about earlier, they have lower credit ratings. So it's a nice picture when you're talking about dollar denominated debt, both historically and in terms of potential returns looking forward. The much harder part is the local side. And so I talked about this before. You've had a 10-year period here. What I'm showing here on the left-hand side of page 11 is the US dollar index. And so the US dollar tends to trade in about 10-year or 12-year cycles. From 1995 all the way up until about 2001, the US dollar appreciated significantly. We then got into a period from 2001 all the way until about 2010, where the dollar sold off significantly. We bottomed out around the financial crisis, and we've been on a pretty strong dollar tear ever since. And if you go back to those 3-decade periods, what 1995 to 2001 represented was a period of U.S. exceptionalism, meaning U.S. growth was significantly higher than that of the rest of the world. Fiscal accounts, if you remember back to the Clinton time, we actually ran a U.S. fiscal surplus. Current accounts were relatively balanced. And so the balance sheet of the United States looked quite good, and the dollar rallied. When we got to the period of 2001 to 2011, that was a period of the China supercycle. So Chinese growth was 12 and 14%. It pulled emerging markets along with it. Commodity prices soared. And so when you looked relatively around the world, emerging markets were a better investment than the United States. And as a result of that, capital left the United States and went into the emerging markets. And I mentioned this earlier, we've been in a period for the last decade where the US has done quite well. If you remember back to your Economic 101 days, there is a concept called potential growth. Basically, you can take every country around the world, and the amount that it should grow by is simply the rate of change of its labor force, plus the rate of change of capital spending in that country, multiplied by its productivity or technological advancement. When you use assumptions in the United States, the potential growth of this country is about 1.8% a year. So the fact that we have been growing at 2.4% over the last 12 years is quite substantial, and it's a testament to significant capital spending in this country and pretty good technological advancement. When you do the same calculation in the emerging world, the average potential growth rate is about 4%. So the fact that EM went from 6 down to 2 tells you that you've had significant policy error over the last decade in the emerging world. And the part of our market that gets hit when you get policy error is defined as significant impediments to capital coming in and investing in your country. So high levels of taxation, high levels of corruption, where people don't want to build factories in your country, people don't want to invest, or lack of technological advancement will bring down your overall levels of growth. So the fact that EM has been growing at 2 versus potential of 4 tells you the magnitude of that problem. So now let's look forward. On January 4th of this year, if we had done this presentation to you back then, we would have told you that it was highly likely that emerging market countries were going to grow at about 5.5% in calendar year 2021, and the United States was likely to grow at 4%. Then January 5th happened, and the Democrats took Georgia. And as soon as that happened, we all then had to factor in stimulus, or I should say additional stimulus in this country. And what started out as a $1.3 trillion package quickly morphed into a $1.9 trillion package that passed very quickly. And now we're talking about a potential infrastructure package later on this year of about 2.5 trillion. So the growth revision that has occurred is that the US is no longer expected to grow at 4.5. It's expected to grow somewhere between 6.5 and 7. EM is still expected to grow at 5.5%. So what has happened over the last 3 months is the outlook for this year has gone from significantly favoring emerging markets to significantly favoring the United States. And that is why the US dollar has been rallying. US Treasury yields have been going higher. And so the US has been the area of outperformance versus the rest of the world. So when you're talking about inflection points going forward, the time that you want to be on the local currency side of emerging market debt or in emerging market equities, which are denominated in local currency, is when you believe we will get to a point where the US growth outperformance is either fully priced in, or you believe that emerging market countries are on the cusp of bottoming out in growth and heading higher. And so when you put together fiscal stimulus in the United States, when you put together vaccine deployment in the United States, and by the way, the United States has done a pretty impressive job when we look across the world at vaccine deployment. I think we're sitting at 33%, 34% vaccine deployment in the United States. The average in emerging markets is about 7 to 8. And so when we put that all together, today we favor dollar-denominated debt. We want to be on the part of the asset class that is levered to the very attractive balance sheets. We do not favor emerging market currencies because we're still looking for US growth outperformance. But as we get closer to the end of this year and the market starts looking forward to 2022, and emerging market countries towards the end of this year start to build up strength from vaccine deployment, from additional growth prospects, from global growth, you should start to see the US dollar peak out and emerging market currencies start to increase. And that will be an opportune time to then get into an asset class, which at least from the right-hand side of this slide, is in significant value. And then you'll also have the trigger to attach to that value. And so I'll leave you here on slide 12 with what we have been seeing in terms of overall flows. So this is an asset class which has seen significant flows over the last 15 years. There have been a couple distinct periods where you saw $200 to $300 billion worth of inflows. This is global fixed income investors looking for additional yield. And where you really saw this was 2009 to 2012, in addition to 2016 to 2019. We are seeing a similar type of period now. Over the last 9 months, we have seen about $81 billion go into emerging market debt. What investors are chasing are those better balance sheets. What they're chasing is eventually that better growth. What they're chasing is those lower overall default rates. And as a general statement, better fiscal accounts and better current accounts than what you get in the developed world. So when you put it all together, the attractiveness of emerging market debt, it's a large asset class that gives you liquidity, gives you insulation from rising treasury yields, gives you shorter duration, higher coupons, higher yield. You have to be able to dynamically move between dollar-denominated debt at a time like this, eventually over to local currency debt when the growth period or the growth outlook starts to shift. And you have to be able to do the bottom-up credit work across these countries to avoid some of the blow-up situations in countries that are exhibiting poor policy choices that eventually results in bond market vigilantes going after them. So with that, I know we're running up against the 45-minute mark. I'll stop there and see if there are any questions.
Thank you. Interesting, and absolutely there are questions. The first one, I guess we ought to address COVID vaccine rollouts. I know you briefly touched upon it, but a couple things that emerging markets, it seems that they might be lagging in their response. They also have, well, globally, we have all these variants and the impact. It seems that, it affects some countries in some places and eventually makes it around the world. So your thoughts on that?
Yeah, so COVID has been, or the estimates for COVID have been very surprising over the last 14 months. Back in March of 2020, emerging market countries should have performed the worst under COVID. I mean, you've got a group of countries that have very poor health conditions that are clustered in these mega cities. Sanitary conditions are particularly poor. And so COVID should have, or the mortality rates from COVID should have been the highest in emerging market countries. And in fact, they were not. They were the highest in Europe and the United States. So these large, developed, very strong healthcare system countries around the world, in fact, did very poorly under COVID compared to EM. And I'm not talking about infection rates, because emerging market countries don't do a great job of capturing that. I'm talking about pure mortality rates. And what we realized 6 months, 9 months into COVID was that this happens to be a pandemic that has a major effect on demographics. So in countries that have older populations, mortality tends to be much higher. And one of the main reasons why emerging market countries didn't see the same magnitude of deaths per capita is because populations tend to be extremely young in emerging market countries. Now we're on the flip side. And now we have the opposite, which is that developed market countries, as a general statement, are doing a much better job in vaccine rollout than emerging markets. Now, there are a couple of developed market countries, specifically the UK, Israel, and the United States, which are shooting the lights out in terms of vaccine rollout. Most of Europe is still at 7 or 8% vaccine rollout. Russia, China, Turkey, Canada, all those countries are also at around 7 to 8%. And so I completely agree. We've had a couple developed market countries, and luckily we're in one of them, where the vaccine rollout has been particularly strong. And to your question, the direct result is that growth expectations are much higher in these countries that have done well versus emerging. Remember that we're always looking at rates of change going forward in the market. So the key going forward is when you start to see the developed world peaking out in terms of vaccine rollout, which is a good thing, at 60 and 70%, and you start to see emerging market countries increase at a rapid clip, that's when the market will then start to shift growth expectations. And as I mentioned earlier, the growth expectations are key to trying to make that decision to go overweight currencies.
Great, thank you. And as a reminder, if you do have a question, please type it in the Q&A function in Zoom at the bottom of your screen. We received a question as incorporate or relating to China. And the question is, how different would the statistics and your conclusions be if China was excluded from the analysis, assuming that based on its size, it's included and has a material impact on results?
Okay, that's a great question. So one of the amazing things about China is that China represents about 4% of the dollar-denominated market. And so it is, for all intents and purposes, already excluded from most of those statistics that I mentioned earlier. Where China does have a lot of exposure is their local currency debt. And as most of you know, China was just allowed about a year ago to start being included in all the indices. So in fact, when you talk to your emerging market equity managers, they will quote a much higher growth rate than I did, because emerging market equities have a large China, Taiwan, Korea, India. These are all very, very fast growing parts of the world. When you invest in emerging market debt, our biggest countries are Mexico, Brazil, Russia, Turkey, all countries which tend to grow at around a 4% clip. So from a pure growth perspective, China is already excluded for the most part from our numbers. Now, one thing that I think is underlying that question is at the end of the day, China is the incremental buyer of almost every commodity on earth. And so clearly you can see it in copper. You can see it in iron ore, where they consume about 60 or 70% of those commodities. But even when you get to oil, the incremental oil demand around the world is not driven by the United States and Europe, which are well-developed economies, is really driven by the rate of change of Chinese growth. And so we are clearly past peak China growth. That happened 10 years ago. In fact, the working class population in China, the labor force, is now declining. So China also has a demographic problem. And again, you go back to Economics 101, that means that the potential growth rate of China should continue to go lower as long as that labor force continues to shrink, unless it is offset by large amounts of capital spending or large amounts of technological improvement. And so what the Chinese authorities are arguing right now is all this money which is going into China because their capital markets are opening, that is going to result in significant capital spending, which will then offset any labor force deterioration. So that's going to be the big experiment over the next 10 years. China is at what we call a middle income trap. It tends to be that when countries hit about $10,000 per capita in income per year, suddenly your population goes from just wanting to survive, then they want clean air, then they want healthcare, then they want good schooling. And these are all much more difficult things for a government to be able to facilitate than when you're lower in Maslow's hierarchy of needs. And so you have a lot of countries around the world which hit about that 10,000 level and then had a lot of problems. And level on top of that, the fact that they're in a dictatorship, and so there are a lot of other issues in China. So we'll see from an investment standpoint whether China will be able to get over that hump over the next 10 years. But the good news here is that we have a resurgence, at least over the next 24 months, of global growth. It's more slanted towards the developed world now. It should start to shift towards emerging markets. But in an environment over the next couple of years where you're going to see the highest growth rates globally that you've seen in 50 years, that is a target-rich environment to be able to find countries that can offer you significant returns going forward.
Thanks. I want to move away from some of this specific technical stuff and go back to a consideration that certainly we as trustees have. And because you did briefly mention about exposure and diversification. So how does this investment approach fit into asset allocations for to the extent we can call it typical, but a typical public pension plan?
Yeah, another great question. So in one of the earlier graphs, I showed that emerging market debt represents about 20% of the global market cap for fixed income. Now, to be fair, you should subtract out of that number illiquid instruments. So most corporate debt denominated in local currencies, Indian local debt is not particularly liquid. When you do that, it falls down to a number of about 12%. Now, our client base is half outside the United States, half in the US. All of our non-US clients are already at 12%. Almost all of our US clients are somewhere between 1% and 4%. So there is a significant underweight to emerging market debt in the United States. And we are, historically, this country has been an equity mindset. A lot of our clients get their emerging market exposure through their global fixed income mandates. And our view on this is as emerging market opportunities become on a relative basis to your US and European opportunities so much more attractive, as opposed to your EM allocation simply being an offshoot of a global fixed income allocation, it's starting to get carved out as its own allocation. And so there are a lot of state plans which are now in the United States at 6, 7, 8% allocations to emerging market debt. That is the general trend that we're seeing. And that goes back to what I showed in that last slide of one of the major reasons why inflows have been so high into this asset class. The other thing to note about emerging market debt is we are an asset class that's about 87% institutional. So this is not a retail asset class where money comes in and out based on retail considerations. This is big institutions trying to meet return bogeys and increasing their allocations to try and get that incremental yield.
Okay, we have a couple more minutes. So I think the last question, again, to the extent that you can condense it to a few minutes, is explaining how we've heard for a while about, and I guess it's mostly in developed countries, where there's the concern about negative interest rates. And how does that, if at all, carry over into this segment?
Yeah. Okay. So the 5-minute answer to that question is policy matters in emerging market countries. And I know that implies policy does not matter in the developed world. But in many ways, it doesn't. And let me try and explain this. If any of you have ever grown up in an emerging market country, what typically happens when you get worried is you convert all your money and all your wealth into US dollars or gold, and now sometimes euros, meaning the developed world has always been the bastion of stability where people around the world go to that because the institutional quality in the developed world has been so high. That is why the developed world, and let's just talk about the United States, that is why we can get away with running 15% fiscal deficits, 4% current account deficits. So massive twin deficits, quantitative easing, printing our own money, in Europe, cutting rates to negative, all because of the institutional quality in these countries. Emerging market countries absolutely cannot do that. If they were to do any of those, their currencies would depreciate significantly. So this is why I say policy matters. EM countries, by definition, have to run very, very tight fiscal accounts. They have to have very high levels of credibility at the monetary side. Bond market vigilantes are alive and well in the emerging world. They are nowhere to be found in the developed world. And so from a fixed income perspective, as an emerging market debt investor, this is all great because these countries are forced in the emerging world to have great balance sheets. And yet I'm still able to generate higher coupons and higher yields by investing in them. So it's one of those areas out there where it's actually quite beneficial that policy matters so much. It also gives us a lot of alpha opportunities. Our job at the end of the day is we go down to these countries, we meet the president, the finance minister, the head of the central bank, and we're trying to determine whether the policy construct in that country is appropriate on a going forward basis. And to the extent that it is, these countries can significantly re-rate over the next couple of years, to the same extent that if it's a wrong policy construct, you can see significant underperformance. And so that is our job, is to try and separate the two over time by meeting with those policymakers.
Thanks. And so sorry, my mute button wasn't working quite right. As time is winding up, first of all, MAPERS wishes to thank Lazard Asset Management and everyone involved in preparing today's presentation. I found it extremely informative, so thank you. And thank everyone who joined us today for this presentation. MAPERS has another webinar coming up on Wednesday, April 28th, Investing in a Post-COVID World. And registration is currently available on the MAPERS website. And if you're interested in sponsoring a webinar, or if you have a seminar or topics, a speaker or topic suggestion, please reach out to Michelle at the MAPERS office. And as the vaccines are becoming more available and more of us are able to get them, and MAPER's understanding the importance of networking and personal relationships, we want everyone to know that plans are being made to host 2 outdoor member networking events during the summer. Stay tuned and please check the MAPER's website often. And we will also reach out with emails regarding those events, future webinars, as well as our fall conference. With that, on behalf of the MAPER's board, we wish you, your family, and colleagues good health, safety, and at least for those of us in Michigan, enjoying the warmer, sunnier weather in the days and months ahead.